It is now my pleasure to turn today's program over to Alexandra Rotatori. Ali, the floor is yours.
Thanks, Matt. Good morning, everybody. I'm going to start off this webinar by talking about the U.S. corporate renewable energy procurement market, talking about some kind of current trends, what's happened to date, and what we see happening in the future. Before we get started this morning, I would like to see a breakdown of who is on the call. Matt, if you could push the first poll. Great, thank you. I'm going to close the results just so we have a good kind of distribution of buyers and intermediaries and others on the line. So moving right along, I'm going to talk about the state of the market. Just a little bit of introduction. My name is Alexandra Rotatori, and I work for the Business Renewable Center, which is a project within the Rocky Mountain Institute, focusing on corporate renewable energy procurement. So while we began to see a few deals here and there starting in the early 2000s, the first kind of uptick in market activity in this corporate renewable energy sector began around 2012 and 2013. We've seen a fairly steady growth in the market since then. This market sector is driven by corporate goals and targets, and as you can see, this is companies that have committed to 100% renewable goals by November of 2015. You can see most of the companies did not commit to a specific timeline. They just had the renewable goals that they would complete sometime in the future. And now, skipping forward to August of 2017, RE100 has over 100 members now, and you can see there's a huge increase in corporates that have been making these pledges, and also a huge increase in the corporates that have been making time-bound renewable energy goals. Now looking at how these goals actually translate into actual gigawatts of the market, this is a screenshot of the Business Renewable Center deal tracker. It is covering all additional corporate deals, and I think most people are aware of kind of additionality in the market as a concept, but just to briefly cover it, this does not include any unbundled REC purchases or any PPAs that were signed with existing projects. It only accounts for deals that cause new renewable energy to be brought on the grid. So there's a little bit over 8.6 of gigawatts currently since 2008. This covers the U.S. and Mexico, all virtual PPAs, green tariffs, green power purchases, et cetera. But I would say about 80 to 90% are actually U.S. virtual PPAs. That's definitely the dominant sector of this market. As you can see, there was a pretty steady growth, except for this large upshoot in 2015, which we account for because of the impending ITC and PTC credit that was going to be finished, which was actually extended late in 2015. So a lot of people signed deals in 2015 so that they would be able to claim those credits before it phased out in 2016. So if you remove that uptick, you can see we have a pretty steady increase. Breaking it down a little bit more, this is by quarter, and as you can see in Q1 and Q2, 2017 is definitely on track to beat 2016. We've had a pretty slow start to Q3, but hoping to get a few deals here as the summer holidays kind of end and kind of push us back on track. But we're definitely set to outperform 2016 as a whole. So what does the distribution of these deals actually look like? The 88 corporate renewable energy deals that the BRC has tracked, there are 43 different corporations having signed these deals. As you can see, Fortune 500s are a major stakeholder. They account for about half of the companies, and then almost 3/4 of the different deals / megawatts overall. So not only are they a dominant factor here, but they're also usually signing deals for larger megawatt sizes. You can also see a large presence by data center companies. They're about 1/3 of the companies overall and 2/3 of the megawatts. So while it's been a pretty large and specific company market to date, we've also seen that the market's starting to diversify. You see a lot of food retailers, consumer good companies, automotive companies, healthcare, et cetera. And as you can see, while the average deal size is fairly large, there are a lot of new smaller deals entering the market. And to further demonstrate this point, so far in 2017 there have been 11 deals, and 9 out of 11 deals have been signed by new buyers. So this is definitely demonstrating that the market is opening and welcoming different, smaller buyers into this sector. Like I mentioned before, so far it's been a big company game. So combining kind of intel on current deals that we just reviewed with the sustainability targets we talked about in the beginning, including RE100 commitments, you can see that there's still great demand. Over the Fortune 500, 48% of them total have some sort of sustainability goal. And as you can see, the percentage that's actually signed PPAs thus far is much smaller than that. So in order to hit these sustainability targets, there is definitely going to be a huge demand in the market going forward. And actually, a recent Bloomberg New Energy Finance report states that to hit all current sustainability targets by 2025, there would be an additional 17 new gigawatts. As a reminder, as I mentioned before, total market demand to date has been about 8.6. So that would be over doubling the current market size. Another trend we've seen besides individual company sustainability commitments driving activity in this market are companies moving up the supply chain. Larger companies like Walmart and their Project Gigaton have been working on getting all of their suppliers to also meet their stringent commitments. So Project Gigaton was launched this March, and their goal is to remove a gigaton of GHGs from Walmart's supply chain. Energy is only one of the areas in which companies can help comply, and they supply companies with help them kind of make their own goals and then report annually. So I think another kind of trend to push and open up this market sector is larger companies that are fairly dominant in this area, helping newer companies who may not have the resources move along and enter this arena. And more recently, we've also seen an increase in grassroots action. The We Are Still In campaign, which was created in response to the U.S. pulling out of the Paris Climate Agreement, has more than 2,000 governors, mayors, businesses, investors, colleges, and universities signing to pledge to complete the U.S. original stated goals to the Paris Commitment. And as you can see, they collectively represent over 125 million Americans and over $6.2 trillion of GDP. And this factor is from actually a few weeks ago, so I think it's actually significantly higher now as well. So while those are many of the positive trends that we've seen in the market thus far, over the past few years, the market's definitely faced some headwinds. One of which you guys have all probably heard of before, are historically low gas prices. I won't go too much in depth because I'm sure everyone's been living this. But as you can see, gas prices have significantly decreased over the past few years. We do expect them to stay low for a while, but I don't think they will. I think they will eventually rise because while, as you can see in this graph, the price is above the marginal cost to produce, it's not above the full price. And so it's not economically sustainable in the long term. And why that's important to renewable energy PPAs, as you can see here, the orange line is the NYMEX natural gas settlement prices, and the dotted gray line is SP day ahead, so the wholesale market in California. So you can see the wholesale market is closely tracking natural gas prices, and so right now natural gas is kind of the price to beat. It's what sets the wholesale market price in most areas. And this is just CAISO. However, this trend is followed in many other areas of the country. And so natural gas also with the abundance of new renewable energy, especially wind, over the past few years has led to significantly decreased prices. And again, this is just looking at SPP, but you can see average SPP prices have fallen almost 50% in the past 3 years. So there's definitely some kind of hesitations in the market. However, there's also been some new trends and financial mechanisms that are helping to open up new market sectors to alleviate some of these pressures. So like I just mentioned, demand by corporates everywhere and new corporates that want to enter this market has spurred innovation on the transaction structure side and are also trying to push utilities into action on their renewable energy and helping them with renewable energy goals. As I mentioned before, virtual PPAs have been dominant. However, different companies and in different locations across the countries are coming into the market and asking for new types of structures. Virtual power purchase agreements are only available in organized markets or deregulated markets. So markets that have kind of active wholesale markets where you can have third-party suppliers. A lot of these new options that are on the right are available in all markets, regulated and deregulated, and a few of them are specific utility structures that regulated utilities are offering to help these corporate customers meet some of these renewable energy goals. And on that note, opening up regulated markets is another key trend. In the past few years, deregulated markets have dominated, even though the GDP and electricity production have been more evenly split, as you can see. And however, year to date, 77% of the megawatts signed have been in regulated markets. So there's been a huge push for companies that have load located in regulated markets. There's been a significant pressure on the utilities to open up these new contract structures and allow them to procure renewables somehow. And this has led to companies in these regulated areas which didn't have access to renewables before to take advantage of these contract structures and really push open these new markets, which I believe will create a flood of new contracts and new structures once all of these markets open. One of the options that we've seen in these regulated markets, which has made a big splash, is what the term the BRC has coined Regxit. Two cases are MGM with Nevada Power. In May of 2016, MGM asked to leave Nevada Power and source their own energy. They have a goal of 46% of renewables, and Nevada's renewable energy requirement was not going to allow them to meet that. So they're paying an $87 million fee to leave, and they are going to work with a private procurer to get the 171 megawatts necessary to run their operations in the state. Another more recent option was Microsoft with Puget Sound Energy. That's in April of this year, and they're not completely leaving the utility market, but they are leaving for just their Washington headquarters in Redmond, Washington. They're paying a $24 million fee to leave and procure their own energy just for that headquarters. These are significant pressures on the utilities. MGM, I think, is about 5% of Nevada Power's total demand. So a loss of a customer like that is obviously significant. So if we see this becoming a larger trend, we think that the utilities will begin to open up different programs. And you see this specifically in the case of Microsoft. Their action to leave actually contributed to the creation of the Green Tariff Program, which they released last year in Washington, the Green Direct Program, which already has customers such as Starbucks and REI and a few universities out there. So that definitely makes a difference. The second market option, which has been kind of more common over time, has been the generic structure of green tariffs or green power purchases. It creates a significant premium for prices to pay because the customers are paying energy tariff, they're paying the PPA price, but they're only getting back the avoided fuel cost. So that net cost bar on the right is what they're still paying. So they're paying a lot more than they would be originally. So it's not necessarily economically feasible for all of these different companies to do this. It's not necessarily helpful unless people are willing to pay a premium. So before I move on to talking a little bit about aggregation, I wanted to get a sense of what people are doing in the regulated markets. So Nat, could you push the next poll? Great. Very interesting distribution. So another trend that we've seen is that as smaller buyers are entering the market, they're requiring new and more flexible contract structures. So kind of the second large trend that we've been seeing and that we think is going to be up and coming is a proliferation of new aggregation products or alternative contract structures in the market. And I mentioned a few of these on one of the previous slides, but that's including small block PPAs, special aggregation products, and different types of sort of sleeves. This aggregation is kind of a grouping of small buyers on one large project, and the small block PPAs take a few different forms, but they're generally smaller in size or shorter in contract terms with more competitive pricing than would have been previously if you'd asked for those specific options. The different logos of the companies on this page are a bunch of different BRC members who are currently offering these types of products. So these are fairly kind of large developers in the market, and so you can see this is definitely a product that's getting their eye and a trend that is catching their attention. So similar to the regulated poll, I wanted to see what people's thoughts were on these newer and more flexible contract structures. Not the last poll, please. Great. So that is my overview of the current trends in the market. I think there are a few questions that will come up in Q&A, and we will discuss those at the end of both presentations, but I'm happy to kind of talk about any of the trends and go more in depth into any of the high-level information that I touched on briefly. Thank you very much, and Brian, it's over to you.
Thanks, Ali. I appreciate it. Hopefully everyone can hear me. So, my name is Burhan Koc, and I'm working for ENGIE Resources, currently taking the lead on an initiative to come up with commercial solutions to integrate off-site renewable capabilities into our product and service offering for C&I customers. So the context of my presentation will be basically tailored towards what we are working on and why we think that there's a need for a solution like this in the marketplace. So I'm going to show you the most important slide in my presentation, at least according to my legal team. So so you have it. Essentially, we're trying to provide a generic information and not an advice, so don't go ahead and buy stocks and see that your 401k is shrinking since then. So moving on real quick, I wanted to start out with a poll question. Ned, if you can push the questions, I wanted to kind of gauge your pulse on this real quick. All right. Very educated audience today. The correct answer was 195. I think this survey question was a good segue into what I wanted to cover with you guys today. Before we get into the nuances of what type of solutions we are looking into and why we think that there's a need for that, I wanted to paint the big picture for the audience. I think Ali has done a great job of laying the foundation, if you will, in terms of what has been done in the past and what are some of the trends that we're seeing. So one of the trends that we see in the energy space is the decarbonization. So at ENGIE, we have three pillars: decarbonization, decentralization, and digitalization. Those are the three trends that we see, but I'm going to focus more on the commercial solutions that we can bring to the table in terms of helping customers to reach their decarbonization goals. And we see some trends taking place already. The survey question was geared towards the COP21 and Paris Agreement. It's significant to see that 195 countries agreed on coming up with a common objective. And so far, 159 of them already approved that agreement, if you will. And in addition to that, and I think Ali added some color to some of the other trends that we see to move towards this clean energy era, the decarbonized energy era. Like one of the initiative is the RE100 that she talked about. Currently, there are a total of 102 countries, and the total size of those 102 companies on an annual consumption basis is approximately 150 terawatt hour. That is enough power to supply entire Poland, the country Poland. So this is only 102 countries. Beyond that, there are other initiatives that are taking place, like we are still in United States. So one of the things that we started seeing as we engage more and more with our customers is that they want to make a difference. They want to make their contribution to this movement, if you will. And so there is state-mandated RPS programs in the United States, and they understand that it's a compliance requirement, but they want to be able to go above and beyond that. So we start seeing those companies setting their own sustainability goals or renewable targets. And 100% is just a reference point. Every company can, internally strategize what their renewable targets are. So it can be a company that can say, I want to be a 50% renewable company by 2018, and 75 by the next year, and 100% the following year. So these are all voluntary initiatives, if you will, right? So the company can internally define what they want to achieve and how much they want to contribute to this decarbonization movement. So along the way, it's not populating on the screen, but the ENGIE Resources are offering various sustainability solutions, if you will, to help customers to reach those sustainability goals. One of them is that, again, the one motto that I use, the philosophy that I have, is that the cleanest megawatt hour or kilowatt hour is the one you don't consume. So I think the first step is to focus on how we can reduce your consumption. So through Aptera services, we can help with the energy services initiative. Through Green Charge Network, there's battery solutions we can bring to the table. And also ENGIE Resources can help you with demand response type programs, which all allows you to manage your quantity and reduce your consumption. That way you don't need to worry about getting your power from a renewable source if you're not even consuming it. So that's a nice segue into kind of further painting this big picture in terms of these companies who are wanting to achieve specific renewable targets. Again, hypothetically speaking, let's say you or your customer wants to be a 100% renewable company. Today, we know that the way the system works is that you have a generator, a central power plant, and you have the transmission and distribution lines that will allow to bring that physical electrons to the customer's facility, and you have a retail provider in a deregulated market like ENGIE Resources in the middle, facilitating and accommodating these transactions, right? So one thing the customer can do in terms of reaching to their renewable target is on-site solar. The percentages that I will show on the slide is essentially ballpark percentages for an average C&I customers. Keep in mind that those percentages will change depending on the customer, how much space they have at their facility, etc. But these are good ballpark numbers for an average C&I customer, if you will. So they can basically offset, say, 5 to 10% of their consumption through this on-site solar initiatives. There's also off-site solar initiative that we can help with. That's also, keep in mind that that's a regulatory-driven program. It's only available in certain markets, and I believe we're currently active in Massachusetts and New York, and we plan on moving into some other states in the near term. So it's not going to be applicable in every state. But then again, if you have a customer or if you want to also take advantage of that off-site solar concept, that can offset another, say, 5 to 10% of your total consumption. Now you're at the 10 to 20, 15 to 20% level. Again, if you want to reach to this 100% renewable target, or if your customer wants to achieve that, how are you going to get the remaining 70, 80% from a renewable source? That's where the off-site renewable solutions will come into play. It can be sourced from an utility-scale solar farm, or it can be sourced from a utility-scale wind farm. Essentially, the procurement of that renewable energy from those specific assets will help customer to offset the remaining consumption to allow them to get to the 100%. So over here, I want to pause real quick, Nat, if you can push the second poll question or the survey question. Very interesting. Actually, I kind of like to see the distribution because it's evenly distributed. This was actually a trick question. It was all of the above. So when the number of companies were adding up to the 100, total of 4 companies, in addition to this 3, there was one more company who submitted their proposal to be a 100% renewable company under the RE100 program. So essentially, all 3 of them are qualified to be the 100th company, if you will. As I mentioned earlier, there are a total of 102 today, and that number is growing. So back to off-site renewable space. We kind of painted the picture in terms of why we are doing what we are doing. What are the solutions and options that are available to you and your customer, and how ENGIE Resources can help. And you see now how the off-site renewable solutions will come into play. So I wanted to also paint the picture in the off-site renewable landscape. What has been going on, what are the trends, and where we seem to be evolving towards in terms of innovative ideas and trends. And I think some of those has already been covered on Ali's slides in terms of what has been done and also the emerging trends, if you will. So we have seen traditional PPAs. Again, those are like 15, 20-year long-term contracts. It's unit contingent. Generally, the project developers are leaning towards pricing those contracts at the generation bus bar because they don't necessarily have the trading capabilities to price it at a hub or customer's load zone that requires them to manage the basis risk, etc. And generally, customers' load is expected to be large enough to match a project size so that the project developer can turn around and secure their project financing, etc. And we've seen Google, Amazon, and Apple, those guys signing those long-term unit contingent PPAs. And maybe that was a fit for their strategy and an optimal solution for them. But we started seeing some of the project developers taking the step in the right direction, if you will, to make this a little bit more feasible for other C&I customers. So we started seeing them reducing their PPA term to 10-year, maybe minimum 10 megawatts, still large enough. They can price it at the trading hub, but it's still unit contingent. Again, step in the right direction, but there's still some, concerning or issues for your average C&I customer, if you will, in terms of unit contingency of the supply. That means in addition to load variability, now we have to manage the supply variability, and the size and the term requirements are still big enough not to be a good fit for majority of the C&I space. And then we started seeing some of the marketers, and we've seen some of those names on Ali's slide. They are, again, taking the right steps in the right direction. But then again, it's a 10-year minimum term requirement. They still want to see a good size renewable block as part of that transactions. The good step in the direction is that it's not a unit contingent anymore. So we at ENGIE Resources, we looked at all this evolving, emerging trends, and we said, how can we take this to the next level? Because no matter what has been done so far, it's still not covering the majority of the C&I space. And how can we make this more easily contractable? It's the contracting process is going to be similar to any other retail contract, and the term and the volume requirements are going to be a little bit more appealing to your average C&I customers, and we can manage the price and the volume risk on our end because we can employ a portfolio approach. As you know, ENGIE Resources is the third largest C&I player in the United States, so we can leverage our portfolio approach and manage this type of transactions. So essentially, in a nutshell, three solutions that are really on the table is that voluntary RECs. If you or your customer still want to buy the brown power and bundle it with RECs, that's an option. That's one side of the spectrum, if you will. But some customers are considering that to be like yesterday's new now. They want to have a bigger impact. They feel that just buying paper RECs is not really sufficient to make their contribution towards this clean energy or decarbonized world. So the other end of the spectrum, as I pointed out earlier, was this traditional PPAs and VPPAs. It's great. It has the additionality element to it, but it's not really, not everyone's cup of tea, if you will. So we, again, at ENGIE Resources, wanted to step into this space and come up with a solution that's going to build the bridge between buying paper RECs and doing a long-term unit contingent complex PPA contracts. We called it retail physical green at this point. There's another option you see on the slide. It's basically retail sleeving, and I will think that it's not going to be applicable to majority of the customers that we work with. Essentially, it entails that the customer is already under a long-term, say PPA supply agreement, and they are just needing a retailer to step in to provide those sleeving services, if you will, scheduling, risk management, etc. So, but the focus of this presentation is the products, not the services. So, moving on real quick, what I wanted to do is, we're talking about retail physical green, how it differentiates from the traditional PPA, how we believe that it's superior to what it means, what a traditional PPA means to an average C&I customers. So we wanted to put those side by side to illustrate our viewpoints, if you will. First of all, if you want to do traditional PPA or VPPA, it's going to take a year or two. So time frame to start needs to be taken into your account when you're making your renewable purchasing decisions, because with the retail physical green, we can transact or contract within a couple of weeks or in a month or two. The tenor is going to be a lot more appealing. You don't have to do 10 to 15 years. This is more of a down to 3 years minimum term requirement. We can also, price this structures, if you will, at the trading hub or customer load zone, so that eliminates the basis risk for the customer. It's going to be firm volume. Essentially, this can be offered under any retail contract we currently offer. It can be a fixed price, a block and index, some kind of load following percentage type retail contract. But under or within each retail contract structure, essentially you will have the volume and price certainty. The other flexibility we wanted to bake into this construct was the environmental attributes. Again, all these ideas, all these flexibilities are stemming from our conversations with our customers and based on their feedback. So just to illustrate my point on the environmental attribute point, say you have a customer in Pennsylvania, and let's say they want to procure their renewable energy physical power from a specific asset, wind farm in Pennsylvania. And as you know, the wind RECs, or the RECs coming from a wind facility is trading somewhere between $3 to $6 or $3 to $7, depending on what RPS program that facility will be qualified for and the vintage, etc. So that means if a customer wants to buy the physical power and the RECs from that specific facility, that means they need to be willing to pay the value of those RECs as well. But we understand that within the C&I space, considering an average C&I customer, a lot of the customers will have budget constraints. They're going to be sensitive to the price, and they're going to have high price elasticity, if you will. So the option we want to offer is that so you don't have to buy the RECs from that specific facility. We can keep those RECs, or we can just kind of optimize those RECs in the wholesale market. Because these are fungible, tradable commodities. You can turn around and sell it to someone else. It doesn't have to be bundled. Instead, we're going to substitute those RECs with, say, greenie RECs and that are trading around 50, 60 cents. So with one REC arbitrage decision, if you will, a customer can save their or reduce their cost by $5, $6 just in that hypothetical scenario. So as a result of this retail physical green type structures, they will also have the marketing and environmental claiming rights, if you will. So in other words, subsequent to this type of contracting structures, a customer is going to be able to point to a specific renewable energy facility and claim that they are buying their physical power and the RECs, if they choose to do so, from that specific facility. They are going to be able to use the name of the facility and the picture of that facility in their marketing brochure or sustainability reports, etc. So they are going to be able to make those claims. So essentially, if you look at the traditional PPA versus retail physical green comparisons, you will see that the idea was to make this contract structure as consumable, as digestible as possible for C&I customers. We understand that not everyone is Google, not everyone is Amazon, who may have the budget flexibility and the risk appetite to do a long-term unit contingent PPAs. So we wanted to come up with physical contract structures that can be tied to a specific renewable energy facility that are much more consumable for your average C&I customer. So moving on real quick, so how are we going to decide what is the right, solution for the customer? We talked about RECs, we talked about traditional PPA, we talked about this new retail physical green concept. So as we are engaging with our customers, the approach we are taking is, I know it's going to sound like a cliche, but it's really our philosophy here is that we got to start with the customer and end with the product. We can't just tailor a product and hope that we can sell it and hope that we can create that demand in the marketplace. Instead, we want to listen. We want to understand what the customer is trying to achieve in terms of their sustainability goals, what is really important to them. So based on our engagement thus far, we identified this 10 checkpoints, if you will. So it's, in other words, these are the boxes that we are hoping to be able to check. And on this matrix that you see on the slide, you can go from left to right or right to left. We can start with the left side and ask customers if additionality is important to them, if they have some budget constraints, is tenor important to them, do they like it short term or long term, when are they planning to initiate this renewable target initiative, if you will? Do they have time to wait for a project to be complete within a year or two, or do they want to be able to start right away? What about the volume and price risk? What about the credit risk? What about the contract complexity? Do they have the appetite to deal with the tax, accounting, and legal implications of a complex PPA or VPPA, or do they want to be able to continue with retail-friendly contract structures that they've been used to transact with? So you can start on the left, and based on their answers, you can check the boxes on the right and decide that, okay, this is the right product for this customer, or we can initiate the conversation on the right side and figure out which key characteristics on the left side is critical to the customer. So the idea is essentially to listen to the customer, understand what they are trying to achieve, what's important to them, and come up with a solution that's going to be a good fit for them. And we believe that with the trends that we see in the marketplace in terms of how voluntary RECs are becoming more and more yesterday's news because of its low sustainability impact, customers want to be able to make a bigger impact. And we also see that the traditional PPA and VPPAs are so complex that it's really not going to be appealing to everyone. And we therefore believe that retail physical green type structure will fill that void or the gap, if you will. So this is all I wanted to cover, but I have one last poll question, Nat, if you don't mind pushing it out. I would like to get your feedback on this. Thank you, everyone. The last question was not really, multiple choice questions. Just wanted to get your feedback because your opinion matters to us, and we wanted to be able to incorporate your feedback into how we are structuring these commercial solutions and what are the things that we should maybe further emphasize in structuring these solutions. So I appreciate the feedback. So that's all I got, Nat, and I guess at this point, we are open to Q&As. And so I see a question, is this product only for USA or is it available elsewhere? I trust that that question is geared towards this retail physical green product that we just described. So ENGIE Resources is only operating in United States in terms of helping C&I customers in deregulated markets. So the product that we describe is available in the U.S. As you all know, ENGIE is a global energy entity, and I expect that similar trends will probably take place in other parts of the world. So for global entities who may have renewable targets across the globe, this type of solutions may be applicable in other areas as well, but at this point, we're only focusing on U.S.
I can go ahead and answer through the questions that were directed towards my portion of the presentation too. I think there's a few questions that are kind of summarized by reviewing some of those new contract structures that I talked about in one of the earlier slides. But first of all, one of the questions specifically was, what is a CCA? The CCA stands for Community Choice Aggregation, and it allows the type of contract that allows counties or communities to aggregate load from their individual residents or customers to secure alternative power for them. It's usually run by a local nonprofit, and where utilities are kind of working with those nonprofits to procure alternative sources, usually renewable energy for customers in that area. And it's an opt-in, opt-out program for people who live in those areas. And then I'm going to go over a few of the other kind of types of contract structures that I kind of briefly showed on this slide. Green tariffs. Green tariffs have actually been around for a while. It's been the main way that people in regulated areas have procured renewable energy. It's a process by which you procure energy, through a utility program. One I mentioned earlier is in Washington with Puget Sound Energy called the Green Direct, and it's the way that they're structured is so it protects other ratepayers from the utility from the burden of kind of procuring renewable energy. That's one of the issues utilities usually cite, is that it's going to increase costs for their other ratepayers who don't necessarily benefit from the renewable energy, and these programs kind of put all the extra costs onto the people who are signing the energy contracts so that the other ratepayers don't kind of have to deal with that. And that also covers, that was the picture on the last slide. If you could just either give me presenting rights or go back to the slide on the second to last slide that I had.
Oh, I have to control.
Yeah.
Slide 22. Thank you. So that is the base energy tariff on and for this development, and the rate that they get back is the avoided fuel cost. So right now it's causing a premium from your normal retail power prices. However, as solar and wind costs decrease going forward, it is hopefully a more and more even market. And let's talk about one other briefly, the sleeves, the retail sleeve and the insurance sleeves. Those are newer forms of contract structures where third parties will kind of be in between the customer and the utility and work with the or develop the projects themselves and kind of sign the contracts with the utilities and with the customers just to pass the energy and the renewable energy credits to those customers while those customers still maintain their normal relationships with their utilities. So the sleeves kind of are used in regulated areas, but also the insurance sleeves sometimes offer additional customer benefits of ensuring protection against some of the risks that are inherent in these virtual power purchase agreements. I will answer some of the other questions and go over that again specifically on these online written out so that you guys can have a record of this.
Yeah, I can step in to answer some of the other questions we received so far, Ali. One question was, again, regarding the offsite renewable solutions, the retail physical greening product that I described. Is it available only in states that we operate, ENGIE Resources operates, or is it nationwide? So it's available in all deregulated markets ENGIE Resources are currently active in. So that includes ERCOT, PJM, New York ISO, ISO New England. So this product can be offered in all deregulated markets that we serve in. The other product, the questions, there are a couple of questions. They are all kind of along the lines of how this product can really be structured. So again, in terms of the renewable content of this product and how it may be structured will boil down to what the customer is trying to achieve. Just using couple of hypothetical examples to illustrate the point. You might have a customer that says, I care about locality, and my facility is located in Ohio. I want to be able to say that I support local, say, wind development in my home state. So can you, procure my power from a specific wind farm in Ohio? So in that case, we will be offering our retail physical green product such that the physical power will be tied to a specific wind farm in Ohio, and serve that customer. If customer is indifferent, they might say that as long as it's in PJM or as long as it's a renewable facility, I'm fine. Then in that case, we will be looking at our portfolio of renewable assets that we are working with Some can be external assets that we work with, and some can be some internal ENGIE renewable assets that in the foreseeable future that we plan on working with. So essentially, we can look at those menu of renewable asset options, if you will, and say that we have solar farms in Ohio, wind farms in Pennsylvania, and we have them both in Maryland. I'm just making up examples. So we can give those options to the customers, and they can decide which one is going to be a better fit for the purpose of their, marketing claims, the sustainability pitch. So this product can be structured depending on their need. And I think I already talked about the environmental attribute flexibility, the REC arbitrage flexibility, if you will. Again, if the customer doesn't want to pay for the value of the RECs that will be produced from that specific facility, another example is that the solar RECs are trading at $8 to $10 in Ohio these days. So that means you can get the physical power from that solar farm, but if you want the RECs too, that's going to cost you an additional $8 to $10. So the customer may not have the budget to support that or have the price flexibility to accept that. So in that case, they can bundle their physical renewable power from that specific facility with some national greenie RECs. The other question was around how we can structure our retail contract. So again, this will be similar to how we are offering those contracts today. This renewable product can be like a fixed price load following type concept. In that case, on an annual basis, we will be procuring sufficient renewable power from that specific facility to offset customers' anticipated annual consumption, so that they can make their claims. And then also if they want to do like a block and index type structure, in that case, the block of that retail contract can come from a renewable facility. It will be sourced from that renewable facility. And any portion that hasn't been hedged or locked, the index portion, if you will be supplied from the market, which in that case, as you know, it could be a brown power or green power, depending on where the electrons could be coming from, but it will be supplied from the market for the index portion. And within the context of how you are structuring this product, customer will also have the flexibility around what percentage of their consumption they want it to come from a renewable facility. They might say 1/3 of my consumption to be offset by a solar farm and 1/3 to be offset by a wind farm in my home state. And then the last 1/3 of my consumption will be basically just brown power, and I'm just going to bundle that with greenie REC. So there might be some diversifications around how they want to reach their renewable targets, and this product that we described, the retail physical green product, will allow customers to have those flexibilities to hit those sustainability goals. I think those are all the questions that I see on the screen at this point. Nat, in this case, I'll turn it over to you, and thanks everyone for having us on this call.
Thank you again for joining us today. We hope you found this webcast presentation informative. As a reminder, please take the survey that popped up on your screen, as we greatly appreciate your response. This concludes our webcast. You may now disconnect. Have a great day.